Mike Tedeschi, Wealth Management Advisor, Perspective Wealth Planning. With this week's market breakdown video, we're going to take a look at the four major U.S. indexes. We'll look at the U.S. dollar as well as commodities. And we're also going to take a look at the Russell 2000 more in depth, as again, we've talked about it a lot here over the last couple of months, trading inside that nice tight range. The direction it breaks, really, really important. So we're going to jump in and take a look at some historical numbers. Now, first and foremost, I want to start with the S&P 500. Now, I have a 10-year chart up here, so we're going to go all the way back to 2011. And the purple line that I've got on here is the 200-day moving average. And what I want to show you here is that pretty much in every single year, we have a test of that 200-day moving average. So here we are in 2012. Here we are in 2013. We started on the 200-day moving average, then didn't come back and test it until we got to about 2014. We traded above and below it a bunch in 2015 and 2016. 2017 is the only year in recent memory where we didn't come down and test that 200-day moving average, but we started off 2018 touching it right there off of the bat. And as we know, we traded above and below that for the majority of the year. Same thing with 2019. Then in 2020, we of course broke below it. And since the test in July of 2020, we have not tested that 200-day moving average again. Now, the reason why I bring this up, we've seen some weakness here in the market over the last couple of weeks. We still haven't broken any of the previous lows. We still have all of these higher lows in place here. So the uptrend is still intact for the market at the moment. But even if we were to break a little bit below this here, guys, the major level of support for this year is right around that 4,200 level. That was that breakout that we saw back in June. But if we were to fall just a little bit below that and actually test that 200-day moving average, that would be normal market behavior and would not be the end of the world. And we oftentimes talk about support and resistance as zones and not numbers. And so one of the ways that we can really take a look here at this market is that the support zone actually ranges all the way from the price action from March all the way into June. So right around that 4,000 to that 4,200 level with that 200-day moving average right there in the middle. Meaning if we continue to see weakness and we come right down into this zone, if this area holds and we make it bounce, the long-term chart would still be completely and totally intact. So if we see another couple of percent here to the downside, it's not the end of the world. If we start losing that 4,000 level, then we need to kind of change the way that we think about things. All right. Now, the next thing I want to take a look at here is the Nasdaq. Now, the Nasdaq, we know, had its breakout right around that 14,000 level, and you can see we've left these drawings on the chart from that breakout spot, right? Support there comes back all the way to about where we're at right now. So we have an area of support right in here. We want to see this area hold, but if it comes all the way back and tests 14,000, that wouldn't be a problem. This chart really gets broken if we fall below that major key low back in May and June, right around that 13,000 level. So again, another couple of percent here to the downside to see a bounce would be perfectly healthy and perfectly normal when we think about this in the context of historical markets. Now, the Dow, we know, and we've talked about this a lot, really hasn't gone anywhere since March, right? We're basically at that same spot. We have a very clear support at 33,000. We have a very clear resistance up here at that 35,500-ish level, okay? We haven't traded above that. We haven't traded below that since basically March. Now, this, just like the Russell, the way this chart breaks, I think is really, really, really important. Okay, if you get long sideways ranges, which are supposed to be digestions of previous moves, so we have this big move from the downside into this range, and we don't follow through to the upside, that is not a good sign. A breakdown here would mean that this area wasn't consolidation, but was more of a distribution phase as we kind of head back down. Major level that we cannot lose on the Dow, which would really break these charts, is around that 30,000 mark. That is the big, important level from February of 2020, where we failed, all the way to this breakout spot in November and December, and then we pushed from there. So when we look at this, there's nothing wrong with what's going on right now. We've got that sideways range, and it's the same thing that we've got when we take a look in at the Russell, right? There's nothing bearish about this. We look at a continuation of the original move as the higher probability way of this resolving, meaning we came from below into this zone. That means we have a higher propensity to break to the upside than we do to the downside. But regardless of which way it goes, we have to pay attention to it. So if we do break to the downside, just because we had a higher probability of resolving to the upside doesn't mean that we ignore it and get long. That means we need to really take a look at what's going on here over the course of the year and view it as a distribution and change our market stance. But as it sits right now, we're still in the middle of this zone, and as long as we're still in the middle of this zone, there's nothing wrong with the health of the overall market. Even though we've had a rough week or two, you'll notice that the Russell is back to where it was 2.5, 3 weeks ago, whereas the S&P 500 is down a couple of percent, right? So if the Russell was all the way back at that 2100 and, fighting to kind of break below that, that would be a different signal than what we've got right now. So while the S&P 500's fallen over the last 2 weeks, the Russell's basically where it was at 2 weeks ago, right? They popped back, pulled back a little bit, but it's still trading right around there. So we're not seeing that panic selling in the mid and small caps at this point in time. All right. So not a whole lot has changed. As we spoke about this last week, we're still very much paying attention to what's going on in the Russell. Since we're talking about the Russell, let's go ahead and jump into a kind of a more in-depth analysis here. We're going to compare the Russell 2000 after not having a new 52-week high and no 20% down draw. It's a very rare thing, right? In the past 30 years, we've seen this very, very few times, okay? And when we look at this data set, the only other time that we haven't even had a 10% correction in here was back in 2014. And that's where we're at right now, where we haven't even had a 10% correction in the Russell. We're still trading inside that tight zone. It is very rare for us to go this long without making a new high and without having a deep drawdown. We can see when we look at the information in the past, we struggle over the next week or two from this particular data set, but then we are very much positive moving out into the future. And in the past 30 years, if the Russell 2000 has gone this long without a 52-week high and without falling into a bear market, it has broken to the upside every single time. All right, so if it did not fall into a bear market, it was positive every single time moving forward in the last 30 years. We have to go all the way back almost 40 years before we see any negative right there. And if you notice, every time since 1990 on, we have been positive a year later when we have seen this. We keep talking about this. What happens here in on the Russell is really, really important. Historically, we have continued to follow through and break to the upside when we've had these sideways ranges for a long period of time. We're going to continue to pay attention and see if that is the case here. All right. I think, again, what happens with the Russell is really, really important for everything here. Now let's jump in. Let's take a look at the U.S. dollar. The U.S. dollar made a really strong push here over the last couple of sessions. But the line that we've got out on this chart that we have had for a while, we still didn't quite get above that. So this spike high from September of last year, as well as that spike low from March, that is the zone that we're watching. It's about that 94.5 area. Okay, if we get up above that, this totally changes the picture of the overall chart. All right, as it sits right now, we're still below this zone. So we have not had that real breakout here to the upside. But as we have talked about a lot, we had a series of higher lows put in over the last month or two. It looked like it could resolve to the upside, and it has over the course of this week. The question, of course, is can this follow through? Because if we get that break above there, the U.S. dollar really does have room to run all the way back up almost to that 96 zone before our next level, and then we get up about 97.5 until that next level. All right, this is still a big messy chart. Again, when we back this thing out, we look at it in on a monthly time frame. We could be bottoming in the context of we ran into the important support zone going all the way back to 2010. Right, but we still have a lot of overhead resistance because really over the last 10 years, it's traded in two pieces of this zone. It's either been above 96 or below 96. We're still on that bottom end of this, so we really would need to see a strong push here to get back up. So short term, we have an uptrend. Mid-term, we have a downtrend, and long term, we have a sideways trend. Again, this is just a very tough market to pay attention to in terms of trying to guess what the next direction ultimately is going to be. Right, so that's why we analyze this every single week because it is very, very important, especially when we start talking about commodities. So let's talk about commodities. Oil tried to make the break over 77 earlier this week and fell back down right from it. So, I'll zoom in here on an hourly chart so you guys can see it. We came right into that 77, and now we're all the way back to 74. All right? When we look at this in on a daily chart and we look at this in on a weekly chart, remember, this is that last really, really important level before, and I'm going to back this out now to a monthly chart, we really could get that run all the way back to 100. There's not a whole lot in between here and 100. So what goes on here, really, really important. Continue to pay attention. When we take a look at Nat Gas had an historical move here at the beginning portion of the week where we actually ran all the way up to almost 640 and then had a huge sell-off over the last couple of days. So this thing is really fighting around that mid-5 zone to that $6 range. And again, I'll back this out, look at it in on a monthly. We've talked about this. We have not had the highest close we've had since 2010 is right there at about that 560 zone. So how this market closes on a monthly basis over the next couple of days is really, really important. Again, I think a monthly close over $6 and we see Nat Gas run up towards that $9 zone. Right now, we just kind of have that spike into that zone as a resistance and it's fallen back down. The last time we had a big spike like that was in 2014 where we ran from 480 all the way up to $6. And then, sure enough, we fell back down. So we have to get that close over that zone. Take a look at copper. Copper is still holding in on that $4 zone. So you can see that important level we've talked about between 4 and 450. It's fighting in that range. When we come in and we take a look at gold, gold is still on a monthly time frame. It's still trapped inside this downward movement here over the last year, but you still can look at this as that potential cup and handle. We haven't had a break up or down at this point in time after this long base. The worst news for precious metal bulls is what silver did here over the last week, because silver, and we've talked about how it's held that 22 level all the way since last July, finally broke below it. Okay, if we do not get back up above that 22 zone, silver doesn't have a whole lot of price action support until it gets back down around towards 19. Underneath 19, then that would negate the breakout that we saw last July, and that would really break this market. What happens here in the next couple of days is really, really important, so we're going to continue to pay attention to it. Platinum's still holding over that 900 level. We had a huge bounce from 900 to a little over 1,000. Then we've given almost half of it back. The question, of course, is this area going to hold? A move back up over 1,020 would be very good for this space. We've talked about that extensively. Palladium held onto the low of that 100 area. Last time it had a huge bounce to over 2,000. We'll see if it can, get going again. This chart really does not look very good at all anymore. It's given back the majority of the move. It is almost back. It is back to where we were in 2019. So you really need to see this area hold for the precious metal bulls. Takeaway from today's video is very similar than some of the ones that we've had in the past. Look, we really need to wait and see what happens here on the Russell. The direction that we break from that range is going to be very, very important. So we are going to continue to watch that very closely. As always, if you guys have any questions, you want to discuss anything about the overall market, feel free to reach out to me at mtedeschi at perspectivewealthplanning.com or reach out at 814-580-9881. I hope you guys have yourself a fantastic week. As always, I'll see you guys next week. Take care.